All right, so let's look at risk defined, but we're going to get into risk for a second because this answers Joe's question, how can I get my mind off money and on trading? This answers it. All right, risk in Forex is defined as what percentage of our account balance would be lost if our trade went to stop loss. Okay, pretty clear. Okay, you're talking about questions. Okay, Gloria, rock and roll. Yeah, let's get on. Okay, good stuff. Risk in Forex is defined by the percentage of our account balance that's going to go down. Okay, one of the great benefits of trading with defined risk is that we are emotionally prepared if a stop loss happens. There is no unknown drop in our account balance. Okay, what makes risk defined is the lot size we choose to put on to begin with. We multiply our account balance by 0.02 if we're trading 2% risk at stop loss and divide our stop loss in pips into that number. That will determine the lot size. Okay, an example of that is, say we have a $12,500 USD account. We multiply that times 0.02. That gives us $250. 250 divided by minus 25 pips at stop loss is 10 minis or one lot. All right. So this is 10 minis or one lot trading 2% for an account size of $12,500 USD. Now realize various pairs will each have a different amount because the quote currency, which is the second one, is going to determine which underlying dollar amount is applied. JPY is actually going to be a smaller lot size, etc. All right, there are many free lot size calculators on the web. Okay, use one for the health of your equity curve. All right, if you're trading 2% risk and you have a $12,500 account, and let's say you're trading Euro USD, are you trading one lot? Chances are no. Most people push it much further, much harder before they learn this stuff, before they understand what it is to get your mind out of the money and into the game. Okay, this is actually a pivotal section. Love this stuff. Absolutely love it. And I invite you guys to print out a statement of your trading account to see what your drawdowns are. Okay, it's really nice to go ahead and make 200-300% in a week or two, but what was your drawdown? When you can bring your drawdown down to 2-3% and you were able to double, triple your account in a week, then you're really moving. All right, so with 2% risk at stop loss, one can lose 3 trades in a row and still have enough margin to come back and negate the loss with just one trade. Okay, trading Steve's system properly, 3 trades in a row is highly unlikely. So 2% risk is a nice conservative amount to start with. Okay, this is really this is the other and the rest of the story as far as I'm concerned. And God bless Steve that he allows us to teach this stuff, because I know it's a little boring and a little mathematical and all, but there are no teachers out there doing this. They're all telling you to go long, go heavy, and by the way, I get a couple pips off every trade you take, and all that kind of stuff. We're a little different vibration here. Thank goodness we're not about that here. All right. So mastering the high a day, low a day entries can allow one to trade a pure 3-to-1 risk to reward ratio, meaning one can lose 3 times in a row and with one winner can negate the loss. Okay, so we're wrapping risk assessment back into the high-low drill. So when you master the high-low drill and you get your entries right up there at the high a day, you can keep your stop loss. If it's second leg, 7 pips plus the spread above where you are, that's what? 9, 10, 11, 12 pip stop loss, depending on the pair. You can get nice tight 15 pip stop losses, and that's fantastic. All right, so when you master the high of low day drill, you'll get to the 3-to-1. Before you master high of low a day, and you're putting entries on after M's and W's form, you're most likely in a 2-to-1. But a 3-to-1 is really, really amazing, as the math is going to show. So we're allowing math to shift everything into our favor. Okay, you've had this great teaching by Steve. You've had Carr give you homework stuff. You're going to have all the rest of the great DMR crew. But I really strongly urge you, if this is new to you and you're a new trader and you're planning on putting some live money on soon, go back and review this, because it's extremely important. And only after the fact, oftentimes, do people really really see the value of attaining a risk to reward ratio as well as a risk at stop loss percentage. Okay, this stuff is vital. I've seen people get killed that are great traders because they don't really think that this is part of their game. They say, yeah, you know, I can beat this thing up, and yeah, I'm really good, and Tim's tripled his account, and Rick Dion's has done crazy. All these guys are so good, I can just go with Steve's thing. Who needs to worry about risk? All right, just too many times I've seen that happen. Please, please, please master the high-low day entry, then apply a standard risk to reward ratio, and then apply a nice tight percent risk at stop loss. It really is going to take your mind off of the money, Joe. All right, so an example, solid high-low day entries can warrant a 15 pip stop loss. We talked about that. All right, if you are good enough to get entries with 15 pip stop losses, you can take 3 stop outs, and that ends up adding up to 45 pips. That means that one 50 pip win can net out to plus 5 pips. Okay, it's a gigantic portion of the game, absolutely huge. Serious professional traders I've spoken with and picked their brains, this stuff is foremost in their mind. 80% of their game is like trying to keep from getting emotional. And the way they can keep from getting emotional is that, okay, I lost once, big deal. It's part of I have my strategy laid out there. Okay, I lost twice, no big deal. Oh, I lost the third time, let me check my shit over and come at it again strong. And okay, I win the fourth time, and there I am, I'm up. Okay, you have to get yourself out of this unpredictable loss mentality where, I don't know, everybody's been through it. You get in a trade, you come back on your screen, you look at your equity, you're like, oh my God, how can that be? We don't want to have any mysteries here. We want to make sure we know what our stop losses are going to look like to our equity. Okay, you plan ahead to take the hits. Okay, absolutely huge. Like I said, this is the type of thinking necessary for consistent equity growth. Yeah, you can bounce around and bring it up and come back down and bring it up and come back down. I did that for the first 4 months of Steve's course because I thought, oh, I'm going to kill it just like Rick did or, Carr did or Abo did. I'm just going to, forget risk. That's for dummies. That's for wimps. I'm a tough guy. I'm going to really put it at him. Okay? And that got me back and forth. Then when I decided that, oh, you know what? The real deal in this game is consistent equity growth. It's gradually rising equity curve. That's everything. I don't care how you do it, how you come about it. At the end of the day, what are you really looking for? Consistent equity growth. In my opinion, one of the key aspects of getting there is having this type of thinking. What is your stop out going to look like? How are you emotionally going to feel when your equity draws down to X amount? 2 or 3 times in a row. Can you come back in the same lot size and hit them and grab 50 out of that and negate the entire loss? Okay? That's the question you got to ask yourself. And the basic idea is that as you hit winning trades, you're going to increase your lot size. And as you hit a losing cycle of 3 or 4 consecutive stop outs, you keep your lot size or you diminish your lot size. As soon as you start using the same lot size when you've hit more than 4 or 5 stop outs, you're going to start over leveraging and your curve is going to start to come down. So this slide is actually wrong. What I really wanted to say is that the basic idea is that you hit winning trades, you increase your lot size. You hit a losing cycle of 3, you come back at them with the same lot size. So your 4th trade should come back at the same lot size. Pretend you didn't see that slide. The idea of using the 2% risk at stop loss is that your 4th trade, you can come back the same size as your first 3 trades. Okay? And we're going to show you graphically why that works. Okay? Managing leverage is the key to sustained equity growth. Absolutely true. Without this last element of discipline, it is quite easy to blow accounts. Okay, I'm starting to speak to those guys that are going to get to about, maybe a C plus or B average in terms of Steve's method and still throw on live money. Okay, once you get to be an A student, yeah, you can ramp it up. You can get into the 5% like Zen does, and I think a few other people do, and, go even crazier than that like some of us have done. But this is geared towards you C and B students who are going to go live while you still have some learning to do, and that is that you don't want to blow out your accounts. How do you blow out your account? You let this stuff run away from you. All right. So there is no reason for a single loss, nor even 2 consecutive losses, to rattle you. Okay? You shouldn't be about money at that point. You should still be about playing the game. What are the market makers doing? What are the fleas doing? Okay? If we have a strategy to manage risk, we can simply come back clear-minded and can trade without fear when the signals reappear. And they're going to reappear over and over and over. And a beautiful, nice, safe trade in GJ last night. Not sure if Steve went over that. Love to show you that chart. It's just sick multi-day W in that pair off of a level 1. All right? I want to change the subject here. Let's stick to risk for now. Okay, this is an example of an equity curve. I've dumbed it down. The red lines are losses, the green lines are wins, and let's just walk through this. This is going to be a little risk-reward visualization why this works, and we're going to estimate our stop loss is 25 pips on our losers, and our winners are all 50 pip take profits. So we have a winner, a loser, a winner, 3 losers in a row, but look, it's actually, we're still up by 1. Okay? We're keeping discipline in our trading. Okay? We're keeping to our 25 pip stop loss. It's basically what this is. We're keeping to our 50 pip take profit. Then we come back win, win, loss, loss, a win, a loss, another win, 2 losses, a win, and then a final loss. And what do we get out of that? All right, we get 8 wins and 11 losses, but we still have a net positive equity curve. Okay? That's because we're dealing with a risk-reward ratio that favors us. Extremely huge point. I've seen a lot of seasoned people come take Steve's class, absolutely kill it. Some of the new guys, because this kind of teaching hasn't been in their repertoire yet, will actually get killed and then question Steve's thing and then come to us in the DMR and look for help. And really, honestly, the problem was they never got a solid risk-reward strategy coming out of the gate. And, of course, I would strongly encourage doing this in demo first as well. Okay? Treat your demo like a live account. It's everything. Let's look at another risk-reward cycle, but let's trim back our stop loss to 15 pip stop loss. And we're going to look at a 50 pip take profit as well. Okay, we can see a kind of different picture emerging. We got a win, a loss, a win. Again, 3 losses, but now we're still up. We have 4 losses and 2 wins. We're still up. Have a win, a loss, another win. 3 losses in a row. We're not paranoid. We're not freaking out. Our equity curve is actually still nicely above our starting point. We have another win, a loss, a win, 2 losses, and a win. I mean, you all know that Casey from Compass is doing better than this, and she's doing great. So as long as we keep our risk-reward ratio in socket, we still have, again, a net positive equity curve. In this case, we only had 7 wins and 12 losses. After I started looking at this as a key component, it was just blown away emotionally. I was like, wow, I can devise a strategy where when I face these guys, I can absorb 12 losses and only have 7 wins, and my equity curve can look like this. I mean, to me, it was amazing when I started looking at that. All right, Steve teaches it. He's been doing this 10 years, if not more. He's an experienced guy. He's looking at a 15-minute chart, seeing all the time frames on it. I mean, God bless him. He's been doing it for a while. Us newer guys who came along, I found it very beneficial to re-explore the risk-reward thing because some of us didn't have that. Some of us that trained with Kramer. Just kidding. I want to beat that guy up too much tonight. All right, so let's take it to its extreme. And we're going to look at a 15 pip stop loss and a 50 pip take profit, and we're going to get the crap beat out of us. And I want to show you how a risk-reward curve actually still benefits us as we get pummeled but still keep our discipline and our defined risk ratio in tight symmetry. All right? We're taking 15 pip stop losses religiously. We're not moving our stop. We're not getting, greedy, and we want to. This allows you to not have to win every trade. It's freaking fantastic. All right? So we have 1 win, 4 losses. Come down a little bit below our entry amount. Get another win, 3 losses. We're back to break even. Won twice. We've lost 7 times. We're back to break even. I don't know about you, but I never did that until I started studying like this. All right, we get our 3rd win, and then we get 4 losses. Coming back down, we're a little bit below break even. Get 1 win, 1 loss, 1 win, 2 losses, and 1 final win. Pushes our equity curve up. And goodness gracious, we have a positive net equity curve with only 6 wins and 14 losses. All right, needless to say, if you structure your risk plan so that you can endure 14 losses and only win 6 times and still have a net positive equity curve, Joe, buddy, you're not going to be thinking about money because you've dialed into your game the needed elements that are going to allow you to build a positive equity curve come hell or high water. All right? Let's look at this. Number 1, we define risk by choosing lot size. That's where it all starts, which is 2% of balance at stop out. Okay? We can then be able to withstand 3 consecutive losses. We have no margin issues. You can come back with the same lot size. All right? Big, big, big point. Okay, there's no emotional turbulence because you have a plan to be able to absorb the losses. Just wait for the next market maker effect signal. Okay, we can use greater than 1-to-1 risk-reward ratio. That means that our take profit is greater than our stop loss. The basis is that we want to use a greater than 1-to-1 risk-reward ratio. Right? We can have more losers than winners and still have an upward equity curve. Okay? Our high of low day skills can enable us to achieve a 3-to-1 risk-to-reward ratio. It's really fantastic when you can trade 3-to-1. All right. And so simply trading with greater than 50% accuracy will bring upward equity. Okay, a lot of great comments coming through from you guys. You know, go up on the forum, throw them up there. It's great to hear from people. I've got a lot of ground still to cover. I'd be looking through some of those comments, so please forgive me for not being as responsive to you. I'm literally fitting 30 pounds in a 2-pound bag here. All right, so we're eliminating turbulence in our brain by doing this stuff. Okay, extremely important. Review it, come back to this. Whatever you can do this in demo a lot and find that place of no turbulence because of it. All right, now let's think of what your equity curve will look like when you can hit 70% accuracy and you still have this determined risk strategy going on. All right? So the basic idea is to keep a consistent ratio of lot size as your account grows or falls. Okay? That means that as your account grows, you use bigger lot sizes. As your account falls, I think I have this written down here, you can still come back after the 3rd or 4th loss and use the same lot size, but once you get past 4 losses, do start trimming down your lot size. You want to keep a ratio of lot sizes in relation to your equity account size. All right, and so obviously the risk-reward part comes in, and that component of the risk plan is to consistently keep take profits larger than stop losses. Okay, bullet points here. And we want no impulsive increases of lot size to make up for a loss. All right, we're using our risk-reward ratio to actually pad our losses by allowing our gains to make up for our losses. So no impulsive lot size. We don't, do the Hail Mary trade, as I call it. The whole psychological ball of wax there. So there it is. No chasing nor Hail Mary trades to try to force the negation of losses. Big, big, big points. You're coming at it like a fencing professional. Okay, you're not coming at it like a Las Vegas gambler, or certainly not like a trained flea. God forbid, don't trade this business like a trained flea. Hopefully, if you've learned anything from this presentation, is not to be a flea. All right, no bugging out emotionally with even a string of losses because you have put the math on your side and have thus created certainty in a turbulent environment. Okay, risk eliminated. Basically, it is. So you can put these together like this, guys. You are eliminating risk. Unless you're totally stupid and, go against this. But really, the only way you can do that is to go against this strategy. All right? So, possible errors to guard against. Okay, and this is sort of where the devil's advocate comes up. This is what will mess you up once you've determined you want to use a risk strategy. Okay, the first error that you might do is moving your stop loss after you've placed it. And as Steve says, the first stop loss is always the cheapest. Okay, now remember, you're using the losses as a component of your overall equity curve. So a loss is no big deal when you've dialed it in this way. All right, so you're putting on multiple positions which add up to greater than your percent risk. This is a no-no. You start to get cocky about this and you're like, okay, I'm going to put on a few more because I feel really good about this trade, or I'm going to put less because I don't feel good about this trade. All right, this is an error to guard against, putting on multiple positions which add up to greater than your percent risk. You do not want to do that. Okay. And the next possible error to guard against is not having the discipline to keep to the risk plan as described. Okay? A lot of reasons we don't like to follow orders in this world. Goodness gracious, with all the garbage out there, there's a lot of reasons to want to be defiant. But in this community, I would suggest you really, really follow the rules. Okay? Experience is going to teach you that. And another possible error to guard against is miscalculating lot size on non-USD quote pairs. Use a lot size calculator. Okay, it's pretty easy to do. There's a bunch of them out there, and you just type in lot size calculator in Google and come up with like dozens of them. All right, so don't think that all lot sizes are created equal. The non-USD pairs, quote pairs, will have a different lot size in relation to your risk at stop loss. Okay, hopefully we're not killing your brains too much here. Another possible error to guard against is not having hard stop losses and take profits with the broker. Okay, I know a lot of guys like to hide the stop losses from the broker, hide your take profits. I'm telling you, get a lightning storm, platform goes down, power goes out, all this kind of stuff. Boy, are you happy you have a hard stop loss with the broker and a hard take profit with the broker. Okay, very important point there. A lot of people are like, I could do a manual stop. I'll do a human stop. Yeah, okay, that's fine, but do yourself a favor, throw in a hard stop just in case the uncertain happens. All right, very big point here. When you're on the right side of the trades, there's nothing wrong with having your stuff with the broker. Why? Go back to that picture in India we showed you with the religious gathering with the probably 10,000 people in that picture. That represents the people going the wrong way. You're one little guy going the right way. It's no problem to throw a hard stop and take profit with the broker. He's not coming back just for you. Okay, so here's an example curve of an 85% win rate with just a 2-to-1 risk-reward profile. And bam, this is more realistic for how you're going to do with Steve's stuff, even when you're not really totally there with it. 7 wins and 6 losses, man, that's an equity curve I'd like. Okay, it's a 2-to-1 risk-reward ratio. Your wins are twice the size of your losses. Okay, and this is just a little little dummy drawing here to show you. Essentially, it's mathematically correct, but to give you guys, since you like charts, a chart view of risk-reward really, really does help. Okay, so let's look at a possible equity gain scenario here. Okay, 2% risk at stop loss and a 2-to-1 or greater risk to reward. We're going to stick with the 2-to-1 at this point. We're going to keep a 25 pip stop loss maintained on all our trades and a 50 pip take profit maintained on all our trades and see how we can do. All right, so our stop loss is going to be 2% risk at stop loss. At 50 pips take profit, that's going to mean each gain is 4%. Okay, only 5 successful trades per week, and you end up with 20% gains for the week. Okay, there's some people here that are doing 5 for 5. That's possible now that you know how the business goes. All right, so 20% a week gains for the week is pretty insane. Okay, I had to draw my little whoa guy there to keep some humor in this, and let's throw up our little Excel sheet and let's run through the math for a second. If you can keep 20% a week, this is essentially what will happen. All right, after a month, you've turned 5 into 10, you've doubled your account. Essentially, double your account every month by getting 20% a week. Now you're going to say, well, Jim, that's just 80% a month. Well, compounding works in our favor, just like it works against us with credit cards, bank loans, mortgages, crawling interest rates, all this kind of stuff. So we're teaching you to be on the right side so you can get out of debt tyranny and enjoy equity freedom. Enjoy your assets. Kick some assets. All right, so you're doubling your account every month. Basically 7 months, you're up to 200 lot level with Timbo down there in the lovely islands, buying a house next to him. All right, all good in the hood. All right, that's the way we roll with this particular presentation. Now, the last component of this presentation, I want to bring to you the GBP JPY from last night. Okay, and I want to play a little game here. I want to erase the candles leading up to this setup so we only see it as it looked on the hard right edge. And I want to alert you guys as well to another presentation I made which deals with how to do what I just did and why it's so important. So let me call up the Market Maker Effects website one more time, and we'll start from scratch here. I don't want to rush through the rest of this, and in doing so, I want you guys to be able to dig into it who are so inclined. So we go to Sunday Sessions Video Archive. All right, on the very first page, we're going to come down here to February 5th, and we've got car levels, and then Jim flashcard technique. Okay, and how this came about, this sort of goes on the heels of the subconscious training, so maybe watch the subconscious one first, and then watch this one, and this is basically how I turned the corner. I stopped looking at trades like this, and started looking at them like this, and all of a sudden, stuff just started clicking. All right, so here we are on the hard right edge, which means that this is what the chart looked like at the moment this trade really got purdy. Okay, and why do we say it's purdy? Well, we have peak formation low, okay, which means what level is this, guys? Anybody have a clue what level we're dealing with there? Who's at the keyboard? Who's fastest? Type it in there. Very good. Okay, Reese, you got it. Level 1. You see a million level 1s coming through. All right, good. Reese is drinking more coffee than anybody, so all good, buddy. He's wide awake. Okay, what do we see here that Steve really likes? We see a tap to the low, a tap to the low, and guess what? On a multi-day W, we see a tap to the low. All right, now this is an hour chart. It's a 1 hour chart. The other thing that's really nice about this is, well, I guess the ADR hit on the back side of it, so we can't use ADR. Either way, we saw it come down to the low on the 1 hour chart. Now let's jump into our 15-minute chart. I'm giving you guys a peek into what we do on the DMR because it's actually relevant here. I'm going to do the same thing. I'm going to erase all the candles leading to what I see as the setup candle. Go down here and take care of all this stuff. Grab the background, get the bucket, dump the bucket, and lo and behold, we see a W. Nice W through the day low tracer. All right. That means that it is 1, 2, 3 hits to the low. This is a multi-day W. Save trade happened when? 6 months ago? 2 years? No, it happened yesterday, June 5th. All right. A lot of stuff working in this trade. Here is your stop hunt box. It's 25 pips in length. Okay. Trade came down, trapped the orders just beneath yesterday's low. Look at that with that little pin. Just enough to grab the breakout order short. They pulled it away quickly, running the stops on those guys. Came back, induced it again, and on up they went. Of course, this is what it looks like. Okay, easy 50 in this pair. This thing actually went almost 100 and something. I mean, it was way up there. It's like 110. Just an incredible trade. Happens over and over again. Okay, you're in a good place. Now let's get into the Tootsie Center, the Tootsie Pop. And this is where we get into the motion flashcards, which will look familiar to you guys who are in the DMR. I like to run these on Monday because it allows us to look at the best setups of the previous week, again, on the hard right edge. So we're going back to Monday, May 14th, 2012, and we're coming online at 1 a.m. Eastern Daylight Time, 0500 Greenwich Mean Time in the Euro-CAD pair. This is what the 15-minute chart looked like there. And this is the 1 hour chart, same pair, but we're jumping up to the 1 hour chart because we're not as gifted as Steve yet to see it all on a 15. I personally like the 1 hour because I can get my level assessment off the 1 hour. And what do we see here? See a peak formation high recently. Okay, that's a clue. We see a peak formation low. All right, let's go back a little further and see what else we see. Okay, within the context of this week, it looks like they created an M at the high. So we're going to call this a level 3 to the downside. And then we're going to call this a level 1 to the downside. This is a 1 hour chart. Okay, and we're going to say that, what are we expecting? we're expecting to rise and sell. So we want to sell upward stop hunts because we are in what? Level 2. This is level 3, level 1, and we're sitting in level 2. But we are mindful of these peak formations that are there on the 1-hour chart. Okay, nice shark fin on the TDI. Steve's going to go into that tomorrow. Okay, here is the 15-minute at 1 a.m. We're going to just let the candles play out. And as you can see, I am actually manually clicking forward. This is not a simulator because Steve's method relies on closed 15-minute candles. One of our students created an EA called Screenshots, which freed up my Saturdays because I used to do these by hand. It's all in that Sunday presentation that I just showed you, so I don't need to get into it. All right, so we see a Euro-CAD trade playing out. Really, we want to see how they're going to handle this high. Okay? That's our big objective here. We're in the shadow box. This is near gap time. Okay, they're coming up. I have to apologize for my day high and day low tracer. They are not drawing correctly in this particular slide, so ignore them. We just want to be mindful of this high back here. Price comes up, okay. Remember, the fencer, he's waiting for his opponent to come into his measure, into his space, across. We're not jumping in, we're not being that guy. In that slide that had that fencer was, don't be that guy, okay. Early birds don't get the worm here. Early birds get killed. You get in short here because you think it's an M. Oh, it's a little, I think this is an M. That's not it. We really want to be patient in this business. Okay, we want to see how they really start to exhibit high of day activity. And that is an example of high activity. Jump up, hold it, just past the Mayo, yank it back. All right, the high-low drill is going to give you guys insight to be able to be online and to see their behavior and to know, this is the high of day. I see it. All right, we can pump you full of intellectual stuff, charts, all of it. The main thing is you got to sit in front of the screen and watch them do this stuff. You'll totally agree that it's actually when the opposing fencer comes across and tries to jab you. Okay, that's when you gain your stance. Sit back, wait for him to hit it again, knock his sword out of the way, and put it right through his throat. Okay. No gore intended, but these guys have stolen from me a lot, so I don't mind getting on the right side of the market makers and making a living at this stuff. Okay, price comes out, pierces through the Mayo 2 times. This is the lovely 2 pins to the Mayo. You've all heard about that trade. Okay, how are they going to handle the close of this candle? Okay, this is a nice reversal here. What do? Bam! They bring it back. Okay, that right there is a beautiful flashcard on the high red edge of a real trade that happened May 14th this year. Not 5 years ago, but a couple weeks ago. All right, so great short trade right there. That is an M on the hard right edge, folks. That's what an M is going to look like for you to trade. And if you're like me and you first laid eyes on this, you were going like, huh? Well, that doesn't look, I really want to go along this thing. All right, but again, this is on the hard right edge. It gets a little dicier here because you don't have the benefit of seeing all this stuff to the right. You're getting on the hard right edge, but what do you have? You have a lot of information. 3 hits to the high, 2 pins to the Mayo, level count from the H1. Let's go look at the H1 again. We'll review the thing. We were expecting an M here based on our level count as well. We have divergence in the TDI. Steve will go into that tomorrow, I believe. And as well, we have a nice 55 pips down to this trap area to the low. That's a Kim Compass nugget where she likes to take profit back to an area because many pending orders are sitting here. It's her view of the market maker strategy, which I respect. So we're looking at a 7:15 a.m. entry to the short side at 7:15 in the morning. So we waited around. We allowed the market maker to do his move. So now we're entering the candy shop. We're going to let it drop. All right, so we're in. Price is moving a little bit against us. New guys will have a tendency to sketch out here. You'll be like, oh my God, I'm up 10 pips. I got to take profit. But, oof, down she goes. Okay, this is the benefit of looking at charts this way. You're essentially compressing the time on screen by doing it this way. It's one of my favorite things to do. I love doing this. In the DMRs, we learn a ton of stuff. They happen every week. It's not like I have to go hunting for these. It's hard to choose which one to grab most of the time. There's so many of them. All right, so we're still short in the EC from up there at the M. And if you're like me, when you first saw this, that was when I started seeing the M, was after it formed. And I realized I had to get around that. And how I got around it was what I just showed you here. All right, so we're coming down. This looks like push 1. This looks like push 2. And sure enough, down we go. We got our 50 pips. All right, beautiful, beautiful trade. Let's look at one more before we close it down. I don't want these guys to have to render their class all night long. I could go on endlessly. I have hundreds of these. Well, I'm going to probably conservatively guess I probably have between about 70 and 100 of them. And I initially did these by hand. It was totally painstaking, and fortunately we got a guy who designed an EA for us to do it automatically. So this is the Euro Yen. We are looking at Friday, May 18th, 2012. We're coming online again at 1 a.m. Eastern Daylight Time. And let's observe our 1 hour chart to see what we see. Okay, I personally keep my 1 hour chart very spare. This is Monday, Tuesday, Wednesday, Thursday, and this is Friday. This is my week dividing line. I just draw a vertical line in there. And the daily high-low tracer gives me a sense of what day it is. All right, so this is Euro Yen. Now, it doesn't take a too versed of a Steve student to think about what type of trade they expect out of this pair. But let's go through and analyze it. We have an M false move week beginning into an expanded level 1. Okay, level 1 hung around for a while. Then it looks like they finally dropped the zone, and we've got a level 2 down here. And we're expecting some sort of level 3 take it back into the range. It's Friday. Friday, they like to take it back into the range. Okay, that's based on ye ol' market maker cycle. Okay, this is definitely something to make a black light poster of, paste it above your bed, throw on the ultraviolet lights, and stare at it for 6 hours and internalize it. Just kidding, you don't have to kill yourself, but definitely, whatever you do, begin to internalize this pattern. It is everything. You know, it's incredible once you see this. I mean, it was in gold a couple weeks ago, just like nobody's business. All right, amazing, amazing, amazing. All right, so this is what we see on level 3. We're expecting a W, 2 hits to the low. We want to get that before it forms and take it back north. Okay, so you can see when we talk about these trades on the hard right edge, we're developing a strategy as we go. We're actually painting a W here, saying this is what we expect. If it doesn't do this, we don't take the trade. Okay, so this is the type of mature thinking that's going to allow you to really come at these guys with the professionalism necessary to be consistent. Okay, and it's just hours and hours of homework on my part. I'm nothing special. Steve's the one who decided to share with us this incredible method, so always truly grateful to Steve for choosing to share this. All right. Something about Fridays. Oftentimes, patterns will run early on Fridays. So, in this case, we're redrawing the Asia box. In this case, we are smarter than a red box. Smarter than a blue box. Okay? This is 1 a.m. on my blue box, so it looks like somewhere around 12:30 they decided to close this box and run the range from 12:45 on. So this is the inducement south. So I would draw the box, basically the bottom of this day low tracer. Okay, so now we're into our stop hunt mode. Okay, it's a way to redraw the box. This is how I draw it conveniently. It's the next slide. Okay, we've already run 33 pips. What is the average length we're looking for coming out of the box? 25 to 50 pips to authenticate a stop hunt low. And can this be any easier? I'm not sure. My seeing eye dog can probably take trades, although Josh has perfect vision, don't you, buddy? He can probably take these trades. He's lying on his back. He loves this stuff. I love trading with my dog. We haven't figured that out yet. All right. Here's a pin to the low, followed by a first leg. We have 1, 2, 3, 4, 5, 6, 7 candles. How long do they work the area? 30 to 90 minutes. All right, they've worked this area long enough for me to say, looking like a W, but we have our stop. It's early, actually early in Friday. I would look at this as a valid trade to the long side. Okay, we got our extended run out of the box. We have our level count in our favor. Extremely oversold for the week. Friday, they like to run it back early, so I'm looking at this as a possible entry, but let's let price come out a little bit into our into our shadow box, which shows us when gap time happens. A lot of times, gap times, they can throw it one more level. Let's see what they do. Okay, they start turning it back up. They've closed above the catch-up. That's a really good sign that we're patiently waiting. Okay, so a close above the catch-up is Steve's technical confirmation entry. So you can obviously see here a W. Here's your reversal candle. I liked the idea of getting in long on these two candles as they started dropping down. All right, that's great to cost average into these. That's another whole ball of wax. Don't want to get into that. I'll just absolutely overwater the flower at this point. But that's essentially putting on longs as price is moving away from you, which becomes very lucrative when you know what these guys are up to. So you're actually getting in towards the low of the day. You can tell I've done the high-low drill a lot because I'm thinking of going long when this thing's actually coming back down for its third hit to the low, which is technically what this is. So on the hard right edge, this is an excellent W, flashcard, motion flashcard as I call it, to take to the long side. That's what a W looks like at the optimum place to enter. All right? When I first saw this, I was all fooled by this business going on. This to me looked like a short. Now it looks like a long. I'm no longer a flea, or at least I'm the flea going the other direction. Okay, so 1 hour chart, I want to refer to it. Okay, again, we had our market maker cycle, and it was a little bit of a variation. They did their false move week beginning. They held out that level 1 for a while, dropped it again level 2, and as expected came down and created their level 3. We're expecting them to rise. Okay, market maker cycle coming through again, a bit of a variation. All right, TDI divergence, we'll go into that for you tomorrow. And whoops, okay, there's our entry. Let's enter at 4 a.m. Eastern Daylight Time, 800 Greenwich Mean Time. There's our entry, nice tight stop loss. And up we go. See if price is cooperative. Does its pullback. Looks like a push 1 to me. Not going to sketch out. And price keeps rising. Comes back below the catch-up. We want to see how they deal with this next candle. Okay. They do a little fake false move to the downside. Now, notice a lot of times they come back to where the entries are. Okay? This is the relentless stuff we go over in the DMR. It's part of our thinking process. That's kind of what I wanted to share here. However, just know that when you expect this to happen, you're not sketched out of your trade. You're still holding your long here. Although it came back and you might have had a little bit of drawdown, but up it goes. Up it goes. There's push 1. We're now looking to go into push 2. We're patient. We're not flipping out. We're in profit, so our 2-hour rule is somewhat negated. I'm bending it a little bit on this one. We go into that as well. In the DMR, we grab our 50. All right, when I say we go into in the DMR, it's just that I don't want to take all night with this because it's absolutely awesome. Steve has invited me to share my particular detox that I went through, and hopefully you guys are seeing this stuff to the point that you're gaining some faith in it. You want to go back and grab some charts on the hard right edge. All right, again, I want to say go look at Jim's flashcard technique. It's excellent. It gives you the mechanics of how I go through and cut the charts up, why I did that, how it helped me turn the corner, a little bit of psychology, nothing about fleas, nothing about wildebeests. It's all charts, I believe. Who knows? It's all good.